Hello, welcome to this week's How's the Market Pensacola. Well, it's kind of funny. Exactly 1 year ago today, I was explaining convexity, how that impacts mortgage markets. All right, here we are today. I'm reading the Wall Street Journal this morning with my coffee, and they're talking about convexity hedging. Now, I'm not going to get into MBA mode here and start explaining duration to the T, but let's just get a 30,000-foot view. When people buy stuff like treasury yields or when they buy mortgage-backed securities, they are trading capital right now for a stream of income. All right, that's the most simplest form. Well, when their return continues, they see returns for opposite investments or other investments that they could be making better return for the same money. Once that starts to get a little higher, they will start to rotate money around. How does that impact mortgages? Well, with the treasury yield rising, they'll get out of mortgage-backed securities and into treasury yields. All right, because those two with reverse, that's called convexity hedging. They're hedging their bet against other things. There's also swap contracts that happen, and again, I'm not going to get into all that. I'm just trying to give you a basic overview. But if they get out of mortgage-backed securities and into higher treasury yields, in order to entice people to continue to come back into mortgage-backed securities, they have to offer a higher rate. Hence why we're seeing mortgage rates rise. That's why we're seeing mortgage rates rise. Now, what happens if they do? Well, I think that the impact the buyer is going to have is going to be substantial soon. I don't know how soon is. Everybody wants me to have that crystal ball going, hey, what do you see what's happening in the next month? You're still at ridiculously low levels. If you look back in 2006, I did a ton of mortgage on the mortgage company at the time, and man, my customers were ecstatic if they could get into the sixes. Absolutely ecstatic if you get the sixes. Right now, if I told somebody their mortgage rate was going to be in the sixes, they would look at me like I had lost my mind. We've been spoiled. But I think that you've got an opportunity right now. I think as sellers, you've got to pay attention, because as the purchase availability of these mortgages becomes less and less, meaning as interest rates rise, the buyer can buy less and less of a property, you're going to see appreciation slow. Do I see anything that is going to stop appreciation in the next couple of years? No, I don't see depreciation happening. I am keeping an eye on inflation, and the amount of convexity hedging that's happening on Wall Street within the banks is concerning me some. Do I think it's going to impact us here along the Gulf Coast anytime really soon, like in the next few weeks? No, it's going to be more headlines than anything else, but it will trickle down. So I say all that to say, hey, we're in a time right now, we're in a period right now, that if you're making moves, either as a buyer or a seller, now would be a good time. If you're on the fence, make the move. Let's chat. All right, because I'll walk you through what we need to do. If we're saying, hey, we may want to pick up something 12 months from now, unless there's a reason, like a really good reason why you need to wait, we might not want to, because those rates are going to continue to rise. All right, they're going to be in the 3s, they're going to be in the 4s, they're going to be in the 5, which is, again, still ridiculously low. But they are not as low as they could be right now. So I think that time frame, that window that we had is starting to close, and we're seeing that with the amount of convexity hedging that's happening on the street right now. Okay, there's the macro level. Welcome to your Wall Street Journal today. I don't think I'm allowed to say that. I think that's a whole copyright thing, but here we are. Instead of doing that, let's talk about what's impacting and what our inventory levels are for these two counties. There's been something new. Let's go. All right, if you've never seen the show, you don't know. I always start off with this slide right here. It says if we have between 6 and 7 months worth of inventory, we have what's called a neutral market. Anything greater than 7 months considered a buyer's market. Anything less than 6 months considered a seller's market. What the slide does not say, anything greater than 9 months is considered a hyper buyer's market. Anything less than 3 is considered a hyper seller's market. I have said that once or twice. I'm trying to figure out if I can do all that with one breath. I can't do it yet. I still have to breathe in. Let's jump over to Escambia County to begin with, and looky. Here comes Cookie. 600,000 plus. We now have 3 sections that have jumped out of the hyper sellers market and is just the sellers market. All right, 3. So everything over 600,000. It used to be that there was, this 600 to 650 didn't have it. So we're seeing an inventory pick up there. Some of this I'm seeing come up doesn't belong in this category. All right, I have seen some sellers getting really, really out there. Like I know of one right now that it's probably worth 320, maybe 310. They're coming on at 480. 480. And it's worth 320. You're starting to get a little out there. But I also know that especially some of the rookie agents are out there. They're just taking some of those things and putting them on for whatever the seller says to, just to try and get something because there's not much inventory out there. I think that if you're an agent doing that, you're doing your customer a disservice. I think it's just going to wind up being mad. But I understand why people do that. And I'm not here to tell you how to run your business. I'm just here to let everybody who is watching this know what inventory levels are looking like. Again, we've got problems between the 100,000 and the 300,000 because 0.9 months, 0.4 months, 0.3 months, that 200 to 250 has, 250 to 300 has the most under contract with 265 contracts right now. But it's at 0.3 months inventory, and 250 to 300 is 0.8 months. Everything else is getting them. The 500 to 550 is 2.1 months, so that's the closest next as far as jumping up to out of a hyper sellers and into a sellers. But everything in Escambia County right now is a sellers or hyper sellers market. And there are 350 active properties total, which is a little bit more than we had last week. So maybe our spring buying season's jumped up. Santa Rosa, 186 active. And look here, 650 to 700 has jumped out of the hyper sellers market. It's just the sellers. The 0 to 50, we still have nothing. And look at that, 150 to 200, there's 8 properties. 8 properties, which is more than the 5 we had last week. But it still says 0.2 months. The 200 to 250, 15 properties. There's just no inventory in Santa Rosa County whatsoever. So there are our numbers. Everything is pretty much a hyper sellers market, except for the first time that I've seen in coming up on a year. At least we have one price point out of the hyper sellers. Do I think that pendulum is going to continue to swing? I do. If you're a seller, you may want to consider pulling the trigger because, I don't think it's going to remain a hyper sellers market. Well, I know it's not going to remain a hyper sellers market forever. We're going to keep an eye on inflation, that convection hedging that I was talking about at the beginning of the show. All that plays a factor. But we're starting to see the pendulum switch just a little, which is why I say, okay, we are going to see a slowdown in appreciation. We're going to. I don't think somebody bought a property right now. I was having this conversation over the weekend with a customer. They bought a property right now. They said, in 5 years, do you think I'm going to be upside down? No, I don't see anything that would say that. Do I have the crystal ball that can guarantee that? No, of course not. But I don't see anything that says that because our inventories are still low. I think our mortgage rates are still low. Those bonds, the duration of those bonds, where they're spending money and they're getting payments in. That duration's going to start to expand because we're going to see less and less refinances as interest rates go up. People don't want to refinance then. So I think a lot of that plays a factor, and that's why I try and bring some of that to this show without getting into too much, because I know you start talking about mortgage-backed securities convection hedging, and some people's eyes will glass over, if not fall asleep. If not just fall asleep. And I get that, but I try and bring you at least a little something so I can educate you, at least in the front of the show, for the macro before we get into these two numbers. I also want to ask a question. If you're here still listening to me, which is, it'll show me that you are if you answer this question, because I'm not going to put it anywhere. I'm only putting it on the video. How many of you that have actually are here and watching the rest of the show would like me to add Baldwin County to this? Baldwin County, Alabama to this entire mix. Thinking about doing that, but I want to make sure that we have enough of an interest to add Baldwin County before I start doing it. So let me know. All right, shoot me a message and let me know. If you're thinking about doing anything, give me a shout. All right, shoot me a message on this, shoot me a text, shoot me a call, whatever. Let's chat so we can discuss your options. Thanks for watching. Have a great week.
I'm a man on a mission.
My mission is to help people break through all the noise out there and
Don't need no permission.
I want to help you get to actual truth. Don't you just want the truth?